gold went up by about 40% during Trump's first term, about 10% a year.
Mm-hmm.
And so it wasn't like, gold didn't do well when Trump was president. But I think it's actually going to do a lot better, despite what the markets are saying right now. I think the markets are wrong again on this. I think a Trump presidency is very inflationary, but that's not bad for gold because the Fed is not going to fight the inflation. In fact, if it tries, the Trump administration is going to beat up the Fed pretty bad, and then put a lackey in there when Powell's term is over if Powell doesn't cooperate, because Trump wants low interest rates.
PeterSchiff, economist and Euro-Pacific CEO, notes that gold rose about 40% during Trump's first term and expects more robust performance in the future, driven by inflation under a potential second Trump presidency. Historically, inflation boosts gold as a hedge against rising prices. Trump's victory initially caused a sharp drop in gold prices, as traders took profits and worried about rising U.S. deficits and borrowing. This pushed up yields and reduced gold's short-term appeal. However, long-term trends remain positive for gold. Gold, a safe haven asset during uncertainty, rose over 50% under Trump and 37% under Biden. The most significant increase, 215%, occurred during George W. Bush's presidency, driven by 9/11 and geopolitical instability. However, the 2008 financial crisis caused a 30% dip in gold prices as fears of deflation and a flight to the U.S. dollar took hold. PeterSchiff argues that many investors believe the U.S. economy is on the verge of a boom, leading them to shift away from safe haven assets like gold in favor of higher potential stock returns. This sentiment is reinforced by solid U.S. economic growth, with the economy expanding at an annual rate of 2.8% in the third quarter, slightly down from 3% in the prior quarter. According to the Commerce Department, the U.S. is on track for one of the strongest performances among significant economies, primarily driven by consumer spending. Schiff warns that current optimism may be misguided. Despite strong economic growth, he argues that inflationary pressures, especially if Trump's policies return, could make gold more appealing as a hedge against rising prices. The focus on short-term stock gains ignores long-term risks that gold could mitigate. This contrasts with the current market view, where solid growth reduces the appeal of gold, as investors favor stocks ahead of the U.S. presidential election, with the economy as a key issue. Before diving deep into this video, subscribe to our channel, hit the bell icon so you never miss an update, and share it with others who may benefit.
Gold is risk off, so people think the U.S. economy is going to boom, the stock market's going to boom. Why do I want to own a safe haven like gold when I can make a fortune in the stock market in this booming economy? They also think that the strong economy is going to mitigate the rate cuts, so we won't get as many rate cuts as the market might have thought. So they think that higher interest rates is a negative for gold. Yeah. Also supporting the dollar. We've had a big rally in the dollar since Trump won, and so that is weighing heavily on gold. Also, we've had some comments, and speculation that the BRIC nations and other nations that were moving away from the dollar are now going to embrace it because they don't want to piss off Trump because he's threatening all these tariffs. And so maybe because now we got, a new sheriff in town, that the move out of the dollar is going to slow, and that the central bank buying of gold, because if central banks try to be more friendly to the dollar to appease Trump, and hey, we're not selling our dollars, right? Don't tariff us. Look, we're your buddies. If they're going to stop that, if they're going to stop selling their gold, their dollars, they don't have to buy as much gold. So there's a lot of reasons that people are thinking, hey, this is going to be bad for gold. Now, look, gold went up by about 40% during Trump's first term, about 10% a year. And so it wasn't like, gold didn't do well when Trump was president. But I think it's actually going to do a lot better, despite what the markets are saying right now. I think the markets are wrong again on this. I think a Trump presidency is very inflationary, but that's not bad for gold because the Fed is not going to fight the inflation. In fact, if it tries, the Trump administration is going to beat up the Fed pretty bad, and then put a lackey in there when Powell's term is over if Powell doesn't cooperate, because Trump wants low interest rates. If you remember, when he was president the first time, he was very critical of Powell for raising rates. He demanded lower rates. He wanted rate cuts. He wanted negative interest rates. He was upset that Europe had negative interest rates and we didn't. He wanted more quantitative easing. And the only way to finance these tax cuts without skyrocketing long-term interest rates is to go back to quantitative easing. So I think that this is going to be an inflationary, 4 years. And I think the short-term impact of the tariffs, of kicking out the illegal immigrants and the tax cuts is going to accelerate an inflation that was already on the rise. So I think the dollar's rise is going to be short-lived, just like gold's decline. Now, by short-lived, could it go on for weeks? Could it go on for months? Sure. I don't know. Like, I don't have a crystal ball as to when the markets are going to turn. Now, Bitcoin, right? Bitcoin is rising. And it's interesting because with everything that I'm describing, you would assume Bitcoin would be going down, right? Because Bitcoin was sold to people as, hey, this is a safe haven asset because the US dollar's in trouble. We have big deficits. We're going to have a lot of inflation. They're going to print a lot of money and buy Bitcoin because it's a better store of value than gold. It's digital gold. Well, actual gold is tanking. So why isn't digital gold tanking? Because Bitcoin isn't digital gold. It's really anti-gold. Bitcoin is a risk-on asset. But the reason it's rising now is because everybody expects the Trump administration to basically do all these great things to get people to buy Bitcoin, such as eliminate all the capital gains taxes on Bitcoin. Hey, you can make a lot of money on Bitcoin. It's all tax-free. And they're thinking that they're going to start a U.S. Bitcoin reserve, and they're going to go into the market and print even more money, create even more inflation to actually buy Bitcoin. Like, the last thing we need is the U.S. government to go into deeper debt to buy nothing, to buy worthless tokens.
PeterSchiff predicts inflation will accelerate, particularly if the Federal Reserve returns to quantitative easing. He believes QE is the Fed's only option to prevent long-term interest rates from rising. The Fed began QE 2008 to increase the money supply and stimulate bank lending by purchasing mortgage-backed and Treasury securities, accumulating $4.5 trillion in assets by 2014. Although the program aided economic recovery, Schiff warns that a significant increase in the money supply could trigger inflation, especially if quantitative easing resumes. He stresses that inflation results from expanding the money supply, not just rising prices in the consumer price index. Schiff believes focusing on the money supply will be crucial under a potential Trump presidency, as rising prices are a delayed consequence of inflation. Inflation occurs when the money supply grows faster than the country's economic output. The Federal Reserve influences the money supply by purchasing short-term securities from banks and injecting capital into the economy. Schiff contends that this money supply expansion is the root cause of inflation, which later manifests as higher prices. Let's get back to the video.
You got to remember that the inflation is the expansion of the money supply. So rather than looking at the CPI under Trump, you got to look at the money supply under Trump and see what was going on there. Because price increases are the lagged effect of that inflation. And also, inflation can prevent prices from falling. You know, falling prices are a good thing, right? It makes things less expensive. Everybody wins. But inflation could prevent prices from falling. That doesn't mean it's not doing harm. It's making things cost more than they otherwise would have. We were going to get a lot higher inflation even if we didn't have the pandemic, based on the policies not only of Trump, but on the policies of Obama, who preceded Trump. You know, the Fed was doing QE1, QE2, QE3, and they didn't even start raising interest rates really until after Trump was elected. So, you know, by the time he got into office, there had been 2 hikes, but I think both of them were after the election. And so up until the time really, you know, Obama left, rates were still at 0. And of course, they quickly returned to 0 later in his presidency once COVID hit. But I think the reason that you're not going to see the low rates of CPI that we saw during his first term is all the pent-up inflation is now surfacing, right? All the years of money printing is now showing up, you know, in consumer prices. And I think that is going to accelerate, especially when the Fed goes back to quantitative easing, which I believe they will, because I think that the only way that they can stop long-term rates from rising is to go back to quantitative easing. Right now, they're still doing, quantitative tightening. They've tapered it a bit. But ever since the Fed cut interest rates, now they've cut interest rates 75 basis points, long-term rates are up almost that much. And they're going to keep rising, especially if people expect this, stronger economy under Trump. Well, if we have, even if the Fed is able to reduce the short-term rates to 4%, there's no reason that a 10-year shouldn't be 6%. But the problem is the economy can't handle those higher rates. The mortgage market, everything would buckle if the Treasury got up to 6%. And I think a lot more banks would fail because a lot more. The banking system is very insolvent right now, thanks to all the low yielding debt that they own, that they accumulated when rates were at zero. The Fed averted another financial crisis when they stopped hiking rates last time, and they bailed out like Signature Bank and a few other, the Silicon Valley Bank, or a few banks that failed. A lot more would have failed had the Fed not stepped up. But the whole system is insolvent. So I think the Fed is going to be forced to go back to quantitative easing because the rate cuts are not going to be enough. But the Fed is going to be going back to quantitative easing as inflation is picking up. That's why at the last press conference, a reporter asked Powell, hey, what's your plan for stagflation?
Yeah.
And the answer was to laugh it off and say, well, our plan is to hope we don't have. We need some serious structural reforms in the economy. And the only way we can get them is if we stop spending and borrowing. The whole time the Fed was supposedly fighting inflation with tight money, money continued to be loose because debt went to all-time record highs. Government debt, all-time record highs. Household debt, credit card debt, record highs. Trade deficit, record highs. Budget deficit, record highs. Everybody is borrowing and spending despite the rate hikes, which proves that the Fed stopped too early. They never raised rates high enough to do the job. They never actually got into restrictive territory. In order to restructure the economy in a way to have sound economic growth, we need much higher interest rates. We need a lot more savings. We can't have record low savings. People have to stop buying stuff on credit. We have to have, but Trump wants to add more air to the bubble. He wants us to get tax cuts and keep spending. And so that can't solve the problem. To solve the problem would require the opposite of what he campaigned on. We need some austerity. We need to tighten our belts. We need to concentrate on cutting government spending and not just waste, fraud, and abuse. Everybody is in favor of cutting waste, fraud, and abuse.
Gold and silver are considered reliable safe haven assets during times of economic uncertainty. Both metals are expected to gain from central bank actions, such as quantitative easing, which are likely to boost demand. Despite short-term market fluctuations, their historical resilience makes them a strong option for preserving value in uncertain conditions. How do you see the future of gold and silver in the current economic climate? Drop your comments below. We'd love to hear your thoughts. If you found this video insightful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon so you never miss an update. Thanks for watching.